I'm going to start us off with our course objectives. I think the number one objective for me is to have some fun. So we're going to have some fun today. We're going to talk a lot about COVID-19. We're going to share some stories, share some observations that Dave and I have had in working through some of these issues. And I think, we tried to really think hard about, well, what is it that this group wants to hear about today? And I think the word that kept resonating with me after having seen the slides that Sean put together was dynamic. I think, when you think about the financial reporting environment, especially when you think about how COVID-19 has impacted it, it's just been so dynamic this year. I think, many of you might have started the year 2020 with this great strategic plan in place. And now I would say maybe it's strategic plan interrupted due to COVID. And of course, COVID has all these other incremental challenges that you have to deal with. You have to deal with the judgments, you have to deal with the estimates, you have to deal with perhaps an increase in the level of documentation that you need to support all of those things. And so we're hoping to give you a little bit of a flavor for how you should think about those judgments, those estimates, that documentation. We'll talk about disclosures as well. I think disclosures are one of those areas that maybe get short shrift from time to time. So we'll talk through some of the disclosures that are really important to think about in the context of COVID-19. I think many of you might do a disclosure checklist every year if you're trying to put together financial statements, but there's areas on that checklist that maybe in good times you sort of gloss over. But when you're dealing with something like COVID-19, you need to pay special attention to some of those areas. Many of you might have received government assistance this year through any of those stimulus programs that have come through. That has presented its own accounting challenges. So we'll talk about how to think through establishing an accounting policy for any government assistance that you have received, because there's various types. There's many different types of government assistance. And we'll walk through a specific example for PPP loans, because I think that's the one that we have seen most often in particular when it comes to government assistance. Dave, in addition to some of the other remarks that Dave will make throughout, he's going to finish us out with some discussion of the FASB. Obviously, the FASB has a mandate to set GAAP, despite any of the accommodations and other help that they've given to stakeholders due to COVID-19. So that's what we want to accomplish. Now we want to hear from you. Down at the bottom of the screen, you'll see the chat function. If you could just go ahead and open up that chat function, and this gives you some free reign to tell us what is it that you want to hear from us. Certainly, you might have an objective for today, and to the extent we can work that into our comments, we're going to do that as best we can. If you share that with us, we will attempt to work those in. If not, we'll work them in at the end. Maybe we'll have some Q&A at the end. I think Don, you mentioned impairments, goodwill, and others. We're going to lead off with that. So good news. We will certainly meet that objective for you. If you have questions throughout, Marty, you mentioned this, but feel free to submit Q&A. You can submit it in the chat if you like. You can submit it in the Q&A function. You can raise your hand. Any of those things, we'll take it throughout. We'll try to save some time at the end to deal with it as well. Info on reflecting PPP loans once they're forgiven. We will do that. Recent SEC developments, specifically guarantor requirements. We don't necessarily have that in our presentation, but that's the new Rule 310 that the SEC has recently put forth. And so if you'd like to hear about that, I can perhaps try to work that into the comments, maybe at the end if we have some time.
Yeah, and keep the ideas coming. As Mark mentioned earlier, we want to keep this dynamic. That's kind of the word of the day, I guess. And we want to keep things moving along and tailor this to what you want to know about.
So let's take a look at what we had planned, and that's obviously on the agenda. So we've sort of worked through some of the introductory remarks. We'll cover a lot of COVID-19 things. We'll start off with impairments. We'll talk about accounting for government assistance, and that's when we'll talk about some of those aspects of reflecting PPP loans upon forgiveness, and we'll have our FASB update and some Q&A as well. So as we work into COVID-19 financial reporting matters, we sort of put together a list of the things that we think were sort of most impacted by COVID-19. Certainly, COVID-19 has a pervasive impact. I think, if you think about it, it probably impacts any number of line items on your financial statements. But if you, hey Dave, can you flip to slide 8 for me? There we go. So if you're thinking about the areas of your financial statements that might be most impacted or more likely to be impacted, we tried to come up with a list. And I think just the overarching challenge of COVID is significant economic uncertainty. When you think about that economic uncertainty, it certainly plays into a number of these areas, in particular with respect to magnitude and timing of cash flows. So you might have had a decrease in your near-term cash flows due to COVID, but there's also a lot of uncertainty about how long that decrease is going to last. In some cases, maybe it lasts into perpetuity. And I think what's helpful for us to think about today is we really haven't dealt with significant, and that's an important word, there's always uncertainty, right, with cash flows, but we really haven't dealt with significant uncertainty in, I'll call it 10 years. So go back to the financial crisis. That's probably the last time that we've dealt with significant uncertainty. But what makes COVID different is, I think generally, at least the way I think about it, is COVID has had perhaps more acute and wide-ranging impacts than did the financial crisis. So Dr. Marcy Russell, I think is how you pronounce her last name. She's the former chief accountant for CNBC. She did a presentation this week at one of the AICPA's national conferences. It happened to be the AICPA's National Banking Conference, but this was just some overview comments on, what did COVID do to the economy? And one of the things that she pointed out was, in COVID, 20 million jobs were lost immediately. So that's a pretty acute impact, right? As opposed to the financial crisis, where it was 8.7 million jobs that were lost, but it was over a lot longer time horizon, right? And one of her, I think, forecasts is that we'll operate at what she called a 90% economy for quite some time. And when she refers to the 90% economy, she's referring to 90% of 2019 results. And so that really gets to this question of how big and how long. And I think, some of the smartest people in the economic forecasting world are saying it's really big. We may have recovered a little bit, but it's going to be a while before we sort of get back to where we were. So when you think about impairments, so we're going to talk about impairments. Those depend significantly on those forecasts of cash flows, and since those forecasts of cash flows are more uncertain, it adds a little wrinkle to how you're going to go about that. Dave will talk about leases. So when you think about leases, COVID has impacted both the lessor and the lessee. You might have a rent concession that impacts both sides of the equation. You've got collectability of payment issues. You might have impairment of lease asset issues. And so we'll talk about that. On the rev rec side, you might have some similar issues there. You might have things like price concessions, collectability issues, things to think about in terms of variable consideration. Maybe you have increases in your costs, and that can impact how you recognize revenue if you're recognizing revenue over time. Dave is our resident expert in debt modifications. So if you have any debt modification questions, get those ready for Dave, because he's here and he's ready to answer them. We'll also talk about debt classification issues, so covenant violations and the like. We'll talk about some compensation and termination reminders. And then we'll talk, I promised you, we'll talk about disclosures. I think disclosures are incredibly important. So we'll spend some time talking about disclosures, and then we'll talk briefly about some of the other things that the FASB and the AICPA is doing with respect specific to some of those COVID-19 impacts. So with that, Dave, I think I'm going to transition over to you, and you're going to give us some thoughts on impairment of non-financial assets.
Sure. Yeah. Thanks, Mark, and thanks, Marty, for providing that nice introduction and really one thing I want to add on to what Mark shared with you about this particular slide, where we have a number of different issues relating to COVID-19, is there's a cross-cutting theme of estimation and judgment, and that's going to be a key thing that we continue to hammer on throughout the next few segments of this presentation. Now, as your organizations continue to navigate through what has certainly been a very eventful year, and I can imagine as we deal with the upcoming presidential election, it will only be more eventful. I want you to keep in mind the different classes of assets that really could be subject to potential impairment. And maybe some of your organizations have experienced or are experiencing or expecting to experience some adverse impacts from COVID-19, such as lower revenues or higher input costs, margin compression, maybe some other increased costs of operations, customer issues, supplier issues. The list goes on and on and on. And there's a number of ways that COVID-19 is impacting companies. And depending on the impacts to a company, there are different impairment models for the different classes of assets that could be impaired. And this being somewhat of a unique year and time, we might see many companies that have multiple classes of assets that potentially require an impairment evaluation. And so, as I look at this slide, first and foremost, we try to summarize some of the classes of assets and the impairment models that are relevant to those classes of assets. But there's a couple things I want to emphasize. And the first is judgment. So, an impairment analysis almost always involves a significant amount of judgment. And, one of the somewhat frustrating aspects of COVID-19 is, for some companies, is this uncertainty over how long and how deep do some of these issues, or might some of these issues persist. And to the extent that there are prolonged significant impacts or significant uncertainties over a company's cash flow projections or revenue projections, there's really going to be a heightened emphasis this year on documenting your judgments in how you got comfortable with your impairment analysis from a projection standpoint, but also just the more incremental decisions made throughout the impairment analysis. Another thing I want to point out is, given that some companies may have to assess multiple different classes of assets for impairment, ordering of the impairment test this year is going to be very important to consider. And generally speaking, what you would do is you'd start with your indefinite life intangible assets, and then you'd move on to your long-lived assets that are held for use, such as property and equipment and amortizable intangible assets. And then you're going to want to take a look as your last stopping ground at goodwill. And we'll touch on that in a little bit here. What I next want to cover is, on this slide, we have several examples of potential trigger events and circumstances that could indicate a potential impairment. And if present, there may be a need to perform an interim basis impairment test. Now, just in scanning this listing, it's really remarkable how many of these indicators apply to companies today, and not just on a one-off basis, but really across a number of companies in multiple different industries. And, again, as I mentioned earlier, this year, there's going to be a strong theme of judgment and when you do your trigger events assessment, that's going to require significant judgment this year. Certainly due to the dynamic nature, again, of COVID and in some cases, the need to continuously update forecasts, some companies might have a very difficult time coming to their judgments about their triggering events review. The one other thing I want to point out about triggering events here is that there really is no set timing of when you perform your triggering events review. It's not something that you only perform at year end or at a period end reporting date, but really it's an ongoing evaluation by management, and it's really important that you remain cognizant of what those potential trigger events are and when they occur. And now, the last thing I want to cover as it relates to impairment in terms of specifics here is with goodwill. Now, for public companies, most public companies will have adopted ASU 2017-04, which takes us from a two-step impairment testing model to a one-step testing impairment model. So it really kind of simplifies the analysis to some extent, and you measure an impairment, you recognize an impairment based on whether the fair value of a reporting unit is less than the carrying amount of that reporting unit, and the measurement is the difference between the two. Now, for private companies, we're at a juncture here where you could be following one of three impairment models. You could be applying the present two-step impairment model, or for some of you, you may have early adopted, or you might consider early adopting ASU 2017-04, which for private companies doesn't become effective until 2023. And some private companies also follow a private company alternative, which provides for goodwill amortization, as well as truncates the impairment test to a one-step impairment test based on when there's a triggering event present. And what I want to touch on here is that if you're a private company and you're in this boat, depending on which model you're following, that could you could reach a different conclusion about whether there is an impairment loss to recognize, and how much of an impairment loss to recognize, depending on which model you're following versus any one of these other models. And so if you're thinking about changing or early adopting ASU 2017-04, or maybe you haven't already adopted a private company alternative and you're thinking about doing that, it's really important as a footnote disclosure that you disclose that change in accounting to the users of your financial statement, so that they can understand under what model did you evaluate your goodwill for potential impairment. Now, that being said about impairment of non-financial assets, what I'm going to do now is I'm going to turn it over to Mark, who will talk about impairment of financial assets. And if there's any specific questions relating to impairments of non-financial assets, we can address those at a later point.
Yeah, Dave, appreciate your comments on the differences between pre and post 2017-04. I think in the number of clients that we've dealt with, sort of on the margin between pre and post ASU 2017-04, there was a lot of people that were saved by the second step of ASU 2017-04 from having to do a goodwill impairment. So you did step one, you said, oh gosh, I think I have an impairment, so now I have to go do that hypothetical purchase price allocation under step two. It was costly, it was hard to do, but many times you might have concluded that you didn't have an impairment to recognize, whereas under a post 2017-04 model, you don't do that second step anymore, so you just recognize the impairment up front. So we're seeing impairments come through a little bit more quickly under the post 2017-04 model. But yeah, let's jump into impairment of financial assets. I think if you look at this slide just holistically and quickly, you'd say, well, there's no AFS debt securities on here. There's no held to maturity debt securities on here. And that was by design. So those models, I think, are fairly well worn. There's also some nuances there about pre and post CECL that make things a little bit more difficult to really summarize. And so given the well understood, I think, models that people apply to AFS debt securities and held to maturity debt securities, we left those off, and we thought we would explore some of the other areas that we've seen become problematic under COVID-19. So let's level set on scope just for a minute. So equity method investments, those are the ones that are accounted for under ASC 323, significant influence. The cost plus method investments, that is intended to describe equity securities that you're accounting for at fair value, but don't have a readily determinable fair value. So you've applied the measurement alternative under ASU 2016-01, which was codified in ASC 321. So let's talk about how those models are the same, and then let's talk about how those models are different. So first off, let's talk about how they're the same. They both require you to figure out whether or not your fair value is less than your carrying amount. Given that in many times equity method investments don't have a readily determinable fair value, and given that the cost plus method investments that we're talking about don't have a readily determinable fair value, determining whether or not fair value is less than carrying amount can be difficult, and it ends up being this qualitative assessment of all the relevant factors. And thinking back to some of those factors that Dave had listed on his prior slide, a lot of those factors are still relevant, are similarly relevant to analyzing equity method investments and cost plus method investments. Now, I will say that if you delve into the GAAP, ASC 321 has a list of factors to consider, and ASC 323, which is equity method investments, has a list of factors to consider when determining whether or not your fair value is less than your carrying amount. But the crux of the matter is, I need to consider the total mix of all the data points that I have and figure out whether or not I think my fair value is less than my carrying amount. And if the answer to that question is yes, my fair value is less than my carrying amount, then I have to go determine what my fair value is. And this is where the two models differ. So the equity method model is an other than temporary impairment model. So once I've figured out that my fair value is less than my carrying amount, which can be judgmental given the qualitative assessment that you're doing, because the investments don't have a readily determinable fair value. So you might have noticed that I maybe glossed over something that maybe is important, but it's sometimes you have an equity method investment that you can determine the fair value because you have a bunch of publicly traded securities of some entity that you've exceeded the equity method threshold on. I'm not talking about those because those are easy to deal with, right? This is when you've done your equity pickup, you've accounted for your equity method investment appropriately, and you still don't know what the fair value of your investment is because there's no way to figure that out unless you have to, unless you go calculate it, right? So you calculate it, you figure out that you're underwater on your investment, then you're applying this other than temporary impairment model. So other than temporary impairment is all about how much, how long, and can I hold it long enough for me to recover such that I'll get all my investment back. And that's where additional judgments come into play. And you'll notice that I teed that up at the beginning with this COVID notion of, well, how long is this COVID impact going to last? No one knows, although some people are saying it's going to last for quite some time. So that really does play into your other than temporary impairment question. Notice also that it's other than temporary impairment, it's not permanent. So you have some judgments there that you have to make with respect to, well, how long does it have to be underwater before it's other than temporary? Is it 2 years? Is it 3 years? Is it 5 years? Is it 8 years? Who knows? You have to sort of develop those judgments based on your specific set of facts and circumstances. In the equity method model, if you determine that your impairment is other than temporary, that's when you book that impairment loss, which is just calculated as the difference between your carrying amount and your fair value. The cost plus method investments model is not another than temporary impairment model. It's just a flat impairment model. So if you calculate your fair value and it's less than your carrying amount, you're going to record that impairment as the difference between the two. Also keep in mind that cost plus method investments is all about whether or not you've observed a transaction. And so cost plus method says record at cost, look for observable transactions that were orderly transactions for a same or similar security. If you see one, you're going to mark it to that amount. If you don't see one, then you're going to do this qualitative assessment. The other wrinkle there is you have to think about, well, how long has it been since I saw that transaction go off, and does that impact my assessment, my qualitative assessment of whether the fair value is less than the carrying amount? But the bottom line in the cost plus method investment scenario is there's no other than temporary piece to it. You just book it when it happens. Now I'm going to shift over to the far right-hand side. This is the financing receivable and contract assets side of the equation. Think about trade receivables, think about receivables from leases, financing type leases, think about your contract assets. Those are all within the scope of CECL if you've adopted it. If not, you're probably within the scope of topic 310, which is the old incurred loss model. But COVID kind of plays into those as well in nuanced ways. So when you're thinking about CECL, CECL says record the expected lifetime credit loss on your assets that you've recorded at amortized cost. Well, COVID, laying that over the top from a lifetime perspective, you have to make this reasonable and supportable forecast of what do you think your losses are going to be on a lifetime basis. COVID makes that inherently more difficult. Similarly, under topic 310 is an incurred model. Well, COVID, and especially the responses to COVID, like government stimulus, play into how do you think about whether or not a loss has been incurred, and it makes it a little bit harder to figure that out. Because what if you had a customer that maybe lost all of their business, but then they took the PPP program? Well, if they took the PPP program, maybe they had sufficient liquidity to continue to pay you, but when that PPP program dries up, then what do you do? And so it becomes an inherently more difficult analysis to figure out, do I have a probable loss under topic 310 to record? So that's just a bit of a flavor for how does COVID play into financial asset impairments. So let's do our first polling question. Susan, if you could open up our first polling question. We thought we'd like to hear from you about what best describes your situation. So you've tested your financial assets, but you haven't recorded anything. You've tested and you have recorded. You haven't tested financial assets for impairment. And wait, what does impairment mean? Hopefully we don't have too many people say, wait, what's impairment mean? But I'm going to give myself a little bit of a break. I'm going to pause. I'm going to give you a little bit of a break. You can pause and ponder this question. And then when we get a pretty good set of responses, we'll compile the results, let you know what the results are, and then we'll continue our discussion. So how are we doing on responses? We did well. So it looks like we haven't even tested financial assets for impairment yet, which makes some sense. I think if you're not preparing interim financial statements, perhaps you haven't gotten to the decision point about, do I really need to test these or not? It's interesting that, wait, what does impairment mean? I wonder who answered that one. So hopefully you were being funny when you.
Well, Mark, I would have, but there was a little note on the bottom of my that hosts and participants cannot vote. Hey, I do have a couple questions though.
Sure.
Can we go back to the prior screen where we had the three boxes? Could you give us some examples, Mark, of equity method investments? You mentioned, the ones that have publicly traded securities are easy, but, when I think of what was happening in that March, April timeframe, I mean, stock prices were just so volatile, so wondering what companies were doing, even if they did have publicly traded equity method investments. And then, we've talked with this group in the past a little about CECL, and we don't have many. I think we had one person that was at a financial institution and wanted to learn more about CECL in that environment. But most people are dealing with trade receivables, and just what have you seen people doing on the trade receivable front as it relates to COVID? End of March, how do you set an uncollectible reserve at the end of March, or even going forward? Like you said, there's uncertainty. You mentioned just wondering what you've seen in practice from either your public or private clients.
Sure. And Dave, feel free to weigh in. I'll answer the equity method one first. I think, Marty, you teed it up as, well, what if you had securities in a publicly traded entity. But I think the answer I'm going to give maybe applies similarly. So remember that equity method investments is an other than temporary impairment model, and so that's helpful when you're thinking about the March timeframe, because I don't think it was too long after March that the stock market took off again, right? So you would have looked at March and you would have said, well, gosh, things are bad now, but has it really been underwater that long? And do I think that the stock market is going to rebound? I think a lot of people said, yeah, if I'm cutting myself off at March 31st, that was still pretty early on. And I think a lot of people said, it's too early to know if this is an other than temporary problem or not, because it just hasn't been underwater long enough. And then as you went through the year, people sort of pivoted, I think, and started thinking more holistically about, well, what industry is that company in? So certain industries, hotels or travel or restaurants, maybe oil and gas, people looked at that and said, okay, those industries might have a stronger argument towards an other than temporary impairment, because those industries might take a really long time to recover. But if you had an equity method investment in a tech company, unless there was something wrong with that entity for other reasons that people looked at and said, well, we're not gonna bring that price back up. I think most people looked at the recovery and said, see, that tells me it wasn't other than temporarily impaired, because look at the stock market today, right? On the CECL side, I think you're right. So CECL is a lot harder when you're talking about long-term, like loans or financing contracts. It becomes a lot harder. But I will say, I think even in the trade AR world, CECL applies to trade AR. You don't get to just use your historical loss rates. You have to take those historical loss rates and adjust them for your reasonable and supportable forecast period. Now, trade receivables have a pretty short period. And so how do you adjust those? Well, there was a lot of judgment that people applied, I think. But what we did observe was there were people making negative adjustments to their historical loss rates, if that's the method that they were using on trade AR. They were adjusting them, and I would call it more of a qualitative adjustment. I'm not for certain people were using really hard quantitative data to make those adjustments, but that's what people have historically done. I think even under an incurred model, say you have long-term receivables and you're applying Q factors to your allowance model, like people are comfortable making those qualitative adjustments. So I think that's generally what we saw. Does that help?
Guys, we skipped question number one, polling question number one. Do we want to go back to it and before we move on?
I think we're good.
Oh, okay.
Okay. Clearly I wasn't paying attention. I didn't see that we had skipped over that. I think I got stuck on the group chat because the slides looked the same. So I apologize for that. But okay. It was a question about, what best describes your organization. So if you want to respond to that in the group chat, that would be helpful to us. Are you a private company? Do you use PCC alternatives? Are you a private company that doesn't use PCC alternatives? Are you public? Are you self-employed? Maybe you're retired. Some days there's days I wish I was retired, but clearly I'm not there yet. So if you want to tell us a little bit about who you are and what your profile looks like, go ahead and punch it into the group chat so we can understand a little bit more about what your perspectives are.
Hey, Mark, there's a question in the Q&A about private company equity method investment. How does one determine fair value? And is there a need to get that equity investment valued by an outside firm? I think this is a great question. Certainly, especially in this time, there's certainly a very relevant question. And I would answer it. Unfortunately, I would cover my answer in the veil of it's a facts and circumstances decision. There may be, in some cases, a need to get an outside valuation done. But really it's going to be a facts and circumstances decision depending on the nature of the losses that investee is reporting, and the comfort level that you as the investor have in the ability to measure fair value. And Mark, I don't know if you have any thoughts that you want to add onto that.
No, I think that's spot on. I mean, I think it can also depend on your degree of significant influence, right? So what do I do if I don't know what the fair value of my investment is? Well, you're probably going to have to do some sort of modeling of that, maybe a discounted cash flow. So if you have pretty significant influence, you might be able to get their budgets and their forecasts, their company specific budgets and forecasts, and that you could use to develop your discounted cash flow modeling. Now, granted, you have to look at that with a critical eye. You might have to put some pressure on some of the assumptions. So that kind of gets back to, well, how much influence do you really have? And are they really going to engage with you if you start questioning their forecasts? But I like what you said about third parties, right? So if they have a very simple equity structure, just, common equity, it's all kind of pro rata, and you calculate a DCF, well, that's a much easier model to come up with. And if you have a really complex capital structure with some crazy waterfall about, how if we liquidate this thing, this is how it's going to look, like that becomes pretty hard to deal with from a valuation perspective. And so that might be the type of investment that you need to get someone else involved with. So I like how you said it. You kind of have to veil your answer with, well, it depends. But it really gets to whether or not you can really do the analysis yourself, or do you need someone to help you with it? All right, so Tony tells us that he is a private company but has adopted public standards. So we applaud you for that, Tony. Great job. So let's get into our next group chat, because I think, given some of the questions that we just got, I think this is going to be an interesting group chat. So tell us about some of the challenges that your organization has faced in testing assets. Now, some of you said we haven't tested we haven't tested our financial assets yet. Maybe you've done a non-financial asset test. Maybe you've had preliminary discussions with your auditor and they're telling you some things that they're going to look for. Maybe you've had experience in the past. Tell us what you think has been the hardest, and then maybe I'll share a story, and Dave, you can share a story too. But I think, the two things on there that I think are most difficult are the last two. So gathering the necessary information and ensuring the consistency in information and assumptions used. So what do I mean by gathering data? And maybe this is sort of part and parcel to not knowing where to start, but one of the things that I think you should be doing when you're thinking about your cash flows for an impairment analysis is you need to anchor those cash flows to something, right? And so what's your anchor? And depending on what industry you're in, maybe you've got industry forecasts of growth, so up growth, down growth, and you would use those growth projections to anchor your individual cash flows. So where are you at today versus where you were at yesterday versus where you think you're going to be tomorrow, using those industry growth projections. There's any number of ways to maybe anchor it, but the sort of the baseline is you have to figure out where those forecasts are going to be. Where's the hard threshold that you're going to hit for your forecast that you could start from, right? And then you get all your information together. The other thing, and this actually becomes a project management issue, but what if you're simultaneously doing a bunch of different impairment analysis? So I had a client recently, they were in the midst of their preparation of their financial statements, and they had to do a going concern analysis. They had to do a goodwill impairment analysis. They had to do an indefinite lived intangible analysis, and they had to do a deferred tax asset valuation allowance. This was all going on all at the same time. And they had different teams doing each thing. The tax team was doing the valuation allowance. The accounting team was doing the indefinite lived intangible analysis. I think maybe they had a third party doing the goodwill impairment analysis, and then their financial reporting group was doing the going concern analysis. And so every time they changed an assumption or realized they wanted to tweak the forecast a little bit, trying to make sure they flowed that down through all of those departments so they got into each of those analyses in an appropriate way, became a little bit of a challenge. So that's the one I've seen pop up most often, is how do I make sure that everybody's sort of working with the same tableau, and everybody's sort of doing the same thing. That can be pretty tough, particularly when you got multiple analyses going on all at the same time.
One thing I'd like to add on to that, Mark, is in some cases, especially as we saw companies closing out 2019 financial statements, but we don't know what might come with 2020, but it's possible we could be in a similar situation. But certain aspects of the accounting exercises require different sets of information, such as, let's say if you're doing a going concern assessment and you're also doing an impairment analysis. A going concern analysis focuses on what are the events subsequent to year end, subsequent to the balance sheet date. Whereas an impairment analysis, you kind of have to step back in your time machine and go back to the balance sheet date and say, what were the facts and circumstances at that time? What were our projections and estimates at that point in time? You can't fast forward into the subsequent period and even though you might know now subsequent to the balance sheet date, well, hey, we've our revenues have softened up considerably because of COVID-19. You can't really take that into consideration when you're doing your impairment analysis. That was a big issue as it related to companies closing out 2019 was, maybe jumping the gun and fast forwarding a little too far when they were looking at their assumptions in their impairment analyses.
That's a great point, Dave. And when we get to the disclosure discussion, in particular the ASC 275 risks and uncertainties disclosure about disclosures, we'll sort of hit on that same point. So I'm glad you brought that up. It looks like Marty can't imagine justifying the forecasts and assumptions to the auditors. We're nice guys, we take reasonable assumptions and we're okay with that. But yeah, I will say, I mean, we just the nature of what we do is we have to ask questions, and so yeah, it can be challenging. But I think we tend to get to a good place. So it's a fun process. So.
Yeah, and this year more than ever, again, is going to be one where you have to, build the set of facts that you're relying on and mesh that together into the story of how you got to that judgment or assumption that you're relying on it for a particular analysis.
All right, Dave, should we transition to leases?
Absolutely. So, as Mark mentioned earlier, there are several ways that COVID-19 is impacting companies from a leasing standpoint, whether you're a lessor or you're a lessee. And what we try to do is capture some of the more prevalent impacts on this slide. Now, the most significant one right now that I'd like to spend a little bit of time on is lease concessions. So as you can imagine, because of all the operational and financial impacts that COVID-19 has had on companies, lessors have in various ways provided different kinds of concessions to lessees, whether that's a free rent period or rent reductions or even payment deferrals that don't change the total lease consideration but just change the timing. There's a variety of different types of concessions. Now, here's the issue with lease concessions. The accounting really hinges on whether the concession is provided for in the enforceable rights and obligations of the contract, or if it's mandated by a law or regulation. Now, if the change underlying the concession is provided for in the rights and obligations of the contract, such as if your lease contract has a force majeure clause in which a change can be allowed in the event of certain unforeseen circumstances, Now that will allow you as a company to not have to evaluate that change as a modification and go through the exercise of potentially reassessing the classification of the lease and remeasuring the consideration. Now, if the concession is not provided for in the enforceable rights and obligations of the contract, then you have to apply the lease modification guidance, which might require a remeasurement of the consideration and reassessment of classification. So, if you think about it, for one lease, this might not be a Herculean effort, but you step back and think about, what about lessors, or what about retail companies that have a number of different brick and mortar stores, or any other organization that has a significant number of leases. That might be a very significant analysis to undertake. So how do we deal with that? And what happened is, back in April, the FASB took a look at this issue and said, my goodness, this is going to be a dramatic impact to a number of companies. So this is really an area where we need to get some guidance out. And simply put, the lease modification literature that's written in the GAAP right now, whether it's in ASC 840 or in ASC 842, really was never intended to address such significant changes to leases occurring in such a rapid manner and such a broad manner, really, across many different companies and many different industries in such a rapid time period, due to a global financial event. And so the fix was, well, the FASB came up with a practical expedient that allows an entity to make a policy election to account for certain qualifying concessions. And you can elect to either account for the concession as a modification, if it would ordinarily qualify as a modification, or you can elect to not apply the modification framework. So let me back up a step. The qualifying criteria are listed on this slide, and what does the policy election really enable you to do? Well, really what it is it allows you to treat, if you so wish to do so, the change as if it was part of the enforceable rights and obligations in the contract, even if it never was. So it's really a benefit to companies who have a number of leases, to potentially alleviate some significant time in analyzing whether the change has to go through the modification framework and potentially change the classification or the measurement of the lease. So that being said, that's Mark, that's all I had prepared on lease concessions. If there's any specific thoughts that anybody has, I'd certainly welcome those thoughts, or anybody who has had any significant concessions made. I'd like to answer any specifics that would be very nice to do so. Oh, one other thought I'd like to add, sorry, Mark. The FASB did come out and acknowledge that, for companies who apply this practical expedient, there may be a variety of different ways that a company could account for a given concession. And so they specifically addressed that potential disparity in practice. And they really wanted companies to emphasize disclosure of the nature of the concession and how the company is choosing to account for that concession if they've applied the practical expedient.
Disclosures are important. We'll hear more about that in a few minutes. So let's talk about RevRec. COVID-19 has certainly had an impact on revenue recognition. I think if you looked around, you could probably find some write-ups about the impact of COVID on RevRec that are 10, 15, 20 pages long. I tried to distill that down into a single slide. So let me just say that I think by and large, the main impact of COVID on revenue recognition is going to be your assessment of collectability and whether or not you're going to have to offer a price concession. So thinking about collectibility, collectibility is important because it's one of the criterion that you have to meet in order to have a contract. So collectibility must be probable at the outset of a contract in order for you to recognize any revenue at all. And so as you go through the contract, you typically don't reassess that unless you have a significant change in facts. And so COVID might represent a significant change in facts that cause you to reassess whether or not collection is probable. And if not, then you stop recognizing revenue and you apply something similar to a completed contract method, which is finish all your performance obligations and get all your money, and then you can recognize revenue. So if you reassess and you think collectibility is not probable, then you do have some pretty punitive results. You might give somebody a price concession. You say, well, you know, I gave you some goods or some services, and I'm gonna allow you to pay me less for that. Well, that might be an AR credit type event. It also might be a price concession that might cause you to reassess your variable consideration. Now, variable consideration goes into your transaction price, and you have to continually reassess. And depending on how that plays out, you'll either assess that from a cumulative perspective and adjust accordingly. In some cases, it might result in prospective adjustment for certain, as I mentioned here, certain modifications to the contract. So from a modification perspective, when you adjust a price concession, when you adjust your price and you give a price concession, you might have a cumulative effect, you might have a prospective effect. So you kind of have to analyze how that's going to play out. And of course, you need to reassess variable consideration. In some cases, if significant, you might have to reverse some of the variable consideration that you'd previously recognized. The other place I would say, well, two things. One is measure of progress reconsiderations. So if you're recognizing revenue over time, you're using a cost to cost method. COVID might have caused your cost of the total contract to go up. And so that might impact how you're recognizing revenue under a cost to cost method. Also, if you change any of your estimates, so you change how you're thinking about collectibility, you change how you're thinking about standalone selling price, you change about how you're thinking about variable consideration, that's all required disclosures under ASC 606. So that does trigger some of those additional disclosures. So that's just in a nutshell, just a quick and dirty explanation of how does COVID-19 impact our revenue recognition. So let's move to our next polling question, because I am interested to know whether or not you've made any modifications to your customer contracts. So if you could open this poll, this one's a little bit different. This one is select all that apply. So you might answer A, B, C, D, E, or F, or multiples of those. So if we can get the poll to pop up. I don't personally see the poll yet. I don't know if anyone else does. Do we have the poll up?
The poll is up and they're voting. I'm not sure why you can't see it, Mark.
Huh. Oh, there it is. I see it now.
Okay. So I'm going to give them another couple of seconds. Everybody get your answers into your polls.
Marty mentioned that there's a little thing that says hosts and panelists cannot vote. I'd be a boring vote anyway, because mine would be none of the above. Oh, and it looks like we have a lot of none of the aboves, and actually extended payment terms and extended contract terms. Those are the ones that I was expecting to see. Although I was expecting to see a little bit more on the reduction of contract consideration. So that's actually interesting. So rather than giving price concessions, it looks like you're just extending out the payment terms. So interesting perspectives. Hopefully you all have digested that. So let's move on to debt. And of course, I mentioned Dave is our resident debt expert. So I'm going to turn it back to Dave.
Hey, Mark.
Yes, sir.
I wish I had known that about a year and a half ago. I may have been calling Dave a lot. I hate debt modifications. I had a syndicate of lenders and had to do that 10% test, I think, for about probably 9 or 10 different lenders.
Oh, that
Yeah.
can turn into a nasty spreadsheet.
That
Very,
was
very, very complex. Well, luckily, Marty, we're going to keep the little segment on debt modifications fairly light. But let's start with a short discussion of debt classification. And, again, in light of all the dynamic, the dynamic nature of COVID-19, companies may have violated or may be expecting to violate a covenant. And so anytime that happens, you think about debt classification. And the key question is, timing is everything. So the key question is the covenant violation occurring before year end or after the period or after the balance sheet date? And if it occurs before the balance sheet date, then, well, unfortunately, the debt needs to be classified as current unless, of course, the company receives a waiver or otherwise refinances the obligation on a long-term basis, unless, of course, the company, maybe due to softness in revenue forecasts or cash flow forecasts, maybe they expect to further violate covenants later on during the year, even after obtaining a waiver. And that's one thing you need to be cognizant of that could put you back into current classification if you've violated a covenant before the balance sheet date. Now, if the covenant breach occurs after year end or after the balance sheet date, that is, typically that's disclosure only and won't affect the classification of debt on the balance sheet. But there really could be other broader implications to consider, and the most important one being, does that have a strong bearing on the company's going concern assessment? And certainly that is a very judgmental exercise, but we saw a number of companies as they were closing out 2019 and even continuing through today, companies with fiscal year ends that are struggling with, what was the timing of the covenant breach, and two, is there an expected or potential future covenant breach that needs to be considered in the assessment of the company's ability to continue as a going concern. Now, back to Marty's favorite topic here, debt modifications. Certainly, this is an area that can get real complex real fast. And companies can modify the debt for a variety of reasons, including this year. Some companies are having a great year and maybe are modifying their debt arrangement for good reasons, either to finance further growth or to finance an acquisition. But some companies, unfortunately, are in a position where they need to modify their debt arrangement to address a liquidity issue. And regardless of the reason for the modification, the first stopping ground is, answering the question of, is the modification representative of a troubled debt restructuring, a TDR? And, for the companies that are doing well this year, that's going to be likely an easy answer. For the companies that are not doing so well and are modifying their debt to address a liquidity issue, you have to go through two conditions here. The first being, is the company experiencing financial difficulties? And this is really actually a fairly judgmental exercise. And there are various indicators. A couple of the indicators are, maybe is the company in default of its debt arrangement, or is the company in substantial doubt of being able to continue as a going concern? And then the second condition is, did the lender grant a concession related to the borrower's financial difficulties? So, this one gets at, at a high level, is there a decrease in the effective, not the coupon rate, but a decrease in the effective borrowing rate after the change compared to the original terms, that really relates to something other than an improvement in the company's credit standing? And, is it really more in substance indicative of the creditor's efforts to hopefully mitigate their losses on the loan? And to the extent that, companies are struggling this year, we do expect that there will be more modifications that qualify or that require TDR accounting. And so what are the impacts? Well, there could be a variety of impacts here, but generally speaking, oftentimes under TDR accounting, a gain likely won't be recognized unless there's a significant forgiveness of debt principal and accrued interest. And oftentimes what happens instead is it's a prospective change in the accounting for the debt in essentially resetting the borrowing rate, the effective borrowing rate on the debt, in measuring that going forward. So now moving, if you don't have a TDR, high level, there's a couple different paths here. One, if you have a line of credit, you look at what is your borrowing capacity before and after the modification. If you have term debt, this is where it gets very complex. You have to assess whether the revised terms in substance really represent an extinguishment of the old debt and the creation of a new debt arrangement if it's substantially different. And you go through this, what's called the 10% test, for those of you who aren't familiar with that. And it can get very, very complex very fast. And unfortunately, we don't have enough time to cover that in tremendous detail today. But generally the impacts on whether you have an extinguishment or not an extinguishment deal with how the unamortized discounts and loan costs are treated, as well as the any fees paid to the lender or third parties in transacting the modification. Now, moving off the topic of debt, I'd like to spend a little bit of time going through some reminders at a very high level relating to compensation and termination benefits matters. And to start with, in regards to share-based comp, if you look at it through the lens of a stock option, some companies have options that vest upon attainment of a performance condition. That might be a revenue target or an EBITDA target, or there's a variety of ones out there. But generally speaking, the compensation expense is recognized when it is probable that the performance condition will be attained. And the probability assessment is an ongoing assessment that a company needs to do each reporting period. And what we're seeing is, some companies pre-COVID, they might have reached a conclusion that it was probable that the EBITDA or whatever performance condition was going to be attained, and so they would recognize the compensation expense under that award. And then COVID happened, and now subsequent, their belief of the probability may have changed to an improbable conclusion. And as a result, when that situation occurs, you have to recognize a cumulative you have to cumulatively reverse the previously recognized compensation cost. Now, what I will say about market conditions, so awards with market conditions, such as maybe the attainment of a specified share price, or if your award has an IRR threshold, the accounting for that is different in that a market condition is really it's an input into the fair value measurement of the award, and so to the extent that you have awards with market conditions and the employees continue to provide service to the company, the compensation expense will likely continue to be recognized regardless of whether the market condition is going to be met. So if the share price, if the market condition is a share threshold and the company's share price has significantly declined, that typically would not impact the continued recognition of compensation expense, because the market condition is really an input into the fair value. Termination benefits is another area I'd like to cover briefly. This is really an area where companies, in response to COVID-19, many people have unfortunately lost their jobs, and companies have dealt with that in a number of different ways through many different kinds of termination benefit packages, whether it's salary continuance for those who are on a furlough or maybe voluntary resignation packages, or you have your classic severance packages for an involuntary one-time benefit. And really the accounting in this area is very facts and circumstances dependent, and it generally you'll generally fall into one of three places in GAAP. That's ASC 420, ASC 712, or ASC 710. And again, because it's very facts and circumstances dependent, one thing I want to emphasize is, to the extent that you have a potentially material benefit arrangement and you're maybe unsure of or it's not readily clear that of where you need to start in accounting for that package, that might be an area where you might want to consult with your outside accountant on to make sure you're starting in the right place. And the last thing I want to touch on with respect to compensation matters is in relation to pension plans. Now, one thing I think about is, how many companies have shut down a division or a plant and or otherwise had significant terminations, and there might be employees who were terminated who are participants in a pension plan. And you need to be very cognizant of what are the requirements for going through the curtailment accounting procedures, and determining whether a curtailment has occurred could involve significant judgment. And if you do conclude that you have a curtailment, you have to go through some pretty significant remeasurement procedures relating to the benefit obligation. So it's something to be cognizant of if you've had a plant closure or significant terminations of employees who participate in a pension plan. So now what we'll do is we'll transition over to speaking to some of the disclosure considerations. And Mark, would you like to take it from here?
Yeah, so I think this slide is just intended to be a little bit of a takeaway to summarize all of the areas that we thought were most likely to be impacted by COVID-19. But on the next slide, I kind of wanted to dig in a little bit on a couple of these items. So risks and uncertainties, I mentioned this earlier. This is one of those areas that I think if you're in good times, people don't pay a lot of attention to. But once you hit something like COVID-19, things become a little bit more difficult. Dave, I think, teed this up nicely at the beginning, where he was, or probably about midway through, where we were talking about, well, the goodwill assessment is as of a point in time. So that's as of 12/31, for example. And it's just an estimate. It's based on the stuff that you knew as of 12/31. But what happens if COVID-19 comes along after the fact? It doesn't impact your estimates as of 12/31, but it does tell you something about whether or not your estimates are reasonably possibly going to change in a material way. And that's what risks and uncertainties disclosures is all about. So as you're going through that disclosure checklist, you don't want to gloss over topic 275 this year, because there's really a meaningful set of disclosures that's in there. We're going to talk about government assistance shortly, but this particular disclosure reminder is all about your accounting policy. So if you enter into new transactions, in particular government assistance that you've never entered into before, you need to update your accounting policy disclosures to address it. And then, of course, we did talk a little bit about this in a couple different places, but if you have changes in estimates or judgments, ASC 250 has general disclosure guidance about changes in estimates, but there's a lot of standards out there that have specific disclosure guidance around, well, what happens if you change your estimates or your judgments. The SEC has issued a couple different pieces of staff guidance specific to COVID-19. We've listed them here. You can go out to their website and go to the CorpFin section of their website and find disclosure guidance topic 9 and 9A. Topic 9 was issued in March, 9A was issued in June, but they give you a flavor for the types of things that the SEC staff is looking for in disclosure documents when you're talking about the impact of COVID-19 through the eyes of management and communicating that to your investors. The next item is a polling question, but Susan, if we don't have a CPE issue by skipping over a polling question, I think I'm going to just skip over this particular polling question because I want to be respectful of the happy hour here in about 10 minutes.
You're
So
good
maybe,
to skip. You're
okay,
good to skip.
Excellent. Thank you so much. So just a couple of other reminders. The FASB has been busy helping people with COVID. So they've delayed certain standards, leases for non-public business entities, revenue recognition. If you were in the bucket where you hadn't yet published financial statements that included the adoption of RevRec, you can now move that back another year if you apply ASU 2020-05. They've issued some Q&As. Dave mentioned the lease Q&A. They had a hedging Q&A about what if COVID-19 causes my forecasted cash flow hedge transactions not to occur? Does that mean it blows up my hedge accounting? The answer to that question was no. And then there was some interest income Q&As about, from the lender perspective, how do I deal with payment deferrals and those types of things.
Hey Mark, we have a question. How far out has the lease delay for private companies been? Is it till next year?
Yeah, pushed it out another year.
To 2022, right?
I think that's right.
Yeah.
I don't have, Dave, you probably know.
Yeah, it was, it got delayed. It got pushed out to 2021 in November, and then again in May it got pushed out to 2022.
Yeah, so you got a pretty long runway still on leases if you're a non-public business entity. All right, so let's talk about government assistance. We are going to get to the question about what do I do with PPP loan forgiveness. Here's a list of government assistance programs. I don't think the details of any one of these are particularly meaningful to this presentation, but we did want to give you a flavor for there's just a lot of stuff out there, and that's why we've come up with this decision-making framework that we'll talk through here. I'm going to skip this polling question as well at this point. But let's talk a little bit about a decision-making framework for how to account for government assistance. The real problem is US GAAP doesn't address how to account for government assistance unless you're a not-for-profit entity. They have specific guidance for not-for-profit entities, but if you're not a not-for-profit entity, you don't have any explicit GAAP guidance that applies to government assistance. However, there may be explicit guidance or industry-specific guidance that would apply to the transaction. And if that's the case, then you would apply that first. So that's step one. You figure out if there's explicit guidance. Step two is it an exchange transaction? Step three is, do you have an existing accounting policy? And step four is select the right accounting policy. This is just a takeaway slide. Let's delve into the details a little bit. So step one, is there explicit guidance? Some of the government assistance that was on that list is just a flat out loan. So ignore PPP for a second. PPP is a forgivable loan, which acts a little bit more like a grant in certain cases. If you just had a loan from the government, maybe it's through Main Street, maybe it's through the Economic Injury Disaster Loan Program, that's just an extension of credit. You're going to account for it under ASC 470. Income taxes, if you have tax credits that you're dealing with, that's all within the scope of 740. And then there's certain industry-specific guidance. So that's like step one. Figure out if you're clearly within the scope of some guidance, some explicit GAAP guidance. If not, then you go to step two, which is this an exchange transaction? In the case of the Medicare Accelerated and Advanced Payment Program, that's about a cash flow issue. So they're really advancing funds for services rendered that you've not yet submitted a claim for. So that's an exchange transaction. The doctor does a service, Medicare reimburses, and this is all about a cash flow advance. So that's where the second question comes into play. Does ASC 606 apply? If not, then you're all the way to step three, which is, do you have an existing accounting policy? I think in many cases, when you think about COVID and the government assistance that goes along with it is so different from anything that has existed in the past, you might conclude that you don't have an existing accounting policy that would apply. If you do have an existing accounting policy that would apply, then of course you would apply that. But if not, then you go to step 4, and this is where the rubber really meets the road. You have to elect an accounting policy. And on the next slide, you'll see that there's a lot of possible models that you might have to analogize to, because if you don't have explicit on-point guidance, you have to pick one. You pick your horse and you ride it. So you've got 470, IAS 20, ASC 958, also ASC 450. So I'm going to skip over the next polling question, and I want to get to walking through a decision-making framework for PPP, and this juxtaposes with that decision-making framework about how do I elect an accounting policy, and you'll see why each of those elections becomes important. So the first thing you ask yourself is, did I even qualify to participate? And if the answer to that question is no, you debit cash, you credit refund liability, and you pay it back as soon as you can. The next step is, do you think you're going to get portions of it forgiven? And now remember, to qualify for forgiveness, you have to spend it on the things that qualify. So if you're spending the money on something that wouldn't qualify, then it just acts like a regular old loan, and you're going to be in the ASC 470 model. You can, of course, as you look through those options about, well, if I can't identify explicit guidance and I need to elect an accounting policy, if you elect to account for the PPP loan under 470, that's A-okay. And in fact, in our practice, we've seen, I would say, the substantial majority of people just elect to apply the 470 model because it's easy. You recognize the loan, you accrue interest, and then when you get that piece of paper from the Small Business Administration that says, congratulations, you met the requirements for forgiveness, and here's your loan forgiveness. When you get that piece of paper, that's when you de-recognize the loan, you de-recognize the accrued interest, and you recognize the gain. Very simple, very easy to apply, very black and white. If you've not elected to follow 470, you've elected some other accounting policy. And if in our practice, if you didn't elect 470, I would say by and large, the other option that people looked at was IAS 20. Now, IAS 20 is a model, and I'll summarize. If we flip to the next slide, you can see how IAS 20 differs from 470. IAS 20 allows, in some cases, to have a little more accelerated earnings impact. So IAS 20 says if it's probable that you're going to have that loan forgiven, that's when you recognize the income. And so it tends to be faster than getting that piece of paper from the SBA that says, good news, you're released from your loan. The problem with that model is it's a probable threshold. And what we've seen in practice is we don't know what the SBA really thinks about forgiveness because there hasn't been that many loans in the marketplace that have actually been forgiven yet. And so then it becomes a little bit more difficult to assess this probability factor. And you don't want to end up on the wrong side of the probability question, because then you're thinking about, well, did I have an error or did I make the right judgment up front? And it becomes that much more difficult. So there's a lot of uncertainty with respect to the program itself. Who will qualify for forgiveness? How is the audit process going to work if you got a loan that exceeded $2 million? And so that's why I think by and large, we've seen people gravitate to that ASC 470 model, because it's very black and white. It's very crisp. It's very easy to apply. So we had one more polling question, but I am going to skip over that because we just have a few minutes left, and I want to give Dave some time to talk about what's up on the FASB, and then I'll try to squeeze in the 310 question right there at the end. So Dave, you want to talk us through what the FASB's up to?
Yeah, and for the purpose of today's discussion, we really wanted to focus on what is relevant in the here and now. And the next few slides, we really view them as takeaways about upcoming accounting standards that are effective in the near future. And certainly this is not an all-inclusive listing, but what we want to do here is list out, give you a good flavor for some of the more relevant standards updates. And really what you see here is a broad theme of, the FASB has really taken a strong effort into finding ways to simplify the application of GAAP. and really without sacrificing what is most meaningful to the financial statement users in their decision-making processes. And so I've highlighted a few here. I'm not going to cover them in detail. The one here at the bottom of this particular slide deals with reference rate reform, and we do have some extended slides on that. I don't believe we'll be able to cover them in detail, but just for an example's sake, we've provided a decision tree that we kind of sketched out that walks through what types of changes a company might make to their contracts that are based on a reference rate such as LIBOR. And if we go back to the background here, LIBOR is expected to go away at the end of 2021, and companies will have to look through all their different kinds of contracts that might be based on LIBOR and potentially replace that reference rate with a different appropriate reference rate. And so, FASB has provided a practical expedient that essentially allows you to, if the change qualifies for the practical expedient, it allows you to account for that change essentially as a continuation of the contract, rather than having to go through the relevant modification framework for that type of contract. When you think about the types of contracts, it might be a debt agreement, it might be a lease agreement, it might be some form of derivative contract. There's various types of contracts that this could apply to, and really, the hard part is going to be, really identifying the types of contracts that have a LIBOR or another type of interbank offered rate that might be discontinued in it, and determining if the nature of any changes that you make qualify for this practical expedient. And on the right-hand side of this page, we have some examples of the changes that, some that would allow the practical expedient to be applied, and some that won't qualify because they're unrelated to a reference rate replacement. And then, lastly, there was recently issued a convertible debt simplification issued, and I'll leave this slide as a takeaway for you, for those of you who have convertible instruments that you issue. And then lastly, we have a takeaway slide here that shows a truncated listing of some of the active projects that the FASB has going on. And really, these are the more significant projects in our eyes that might relate to what your business, that might impact your business. And, again, this is the theme is here, simplification of GAAP. And you see that as a common theme throughout the current ASUs that are currently effective now and in the next few years, and then as well in the project stage.
Well, I'll do 310 in 1 minute or less because I think I can. So Rule 310 is all about subsidiary guarantors, and under the new rules, it relaxes the conditions under which you get to qualify for the omission of disclosures. So rather than being 100% owned, now you just have to be consolidated, and that allows you to qualify for the omitted disclosures. If you don't qualify for the omitted disclosures, rather than doing condensed consolidating information in your footnotes, you're going to do some different non-financial narrative disclosures outside your footnotes. And then they also amended the requirements to provide those disclosures only when the guarantor has an Exchange Act reporting obligation, rather than as long as the guaranteed securities are outstanding. So it just makes it a lot easier to comply with, a lot less costly, a lot less burdensome for those of you that have securities outstanding that have guarantors or are issued by subsidiaries. So with that, I think that'll conclude our presentation. If we have other questions that need to be addressed, we'd love to stick around for a little bit. You've got our contact information. It was at the beginning of the slide, so it's also at the end of the slides. And Susan, I think you're going to send the handout out as a PDF, so you'll have all of our slides. You'll have our contact information. So if you need to find us, feel free to do so. We'd love to chat.
Guys, this was excellent.